Welcome back to Financial Management. Now let's talk about the firms and financial market. The learning objectives in this chapter is to describe the structure and functions of financial markets, distinguish between commercial banks and other financial institutions in the financial marketplace, describe the different securities markets for bonds and stocks. Now, principles 2, 4, and 5 are what is applied in this chapter, that there is a risk-return trade-off, market prices reflect information, individual respond to incentives. The basic structure of the financial market. Now, within the financial markets, there are three principal sets of players that interact. So they are the borrowers, savers, and the financial institutions. Now, your financial institutions, they act as intermediaries. And here is where the borrowers and savers meet, where the savers saves their money or lends their money to financial institutions, and in return, financial institutions lend the money from the savers to the borrowers to earn, of course, interests. The financial marketplace, financial institutions. Now, figure 2-1, financial marketplace, institutions, and the circle of money. So this is how the money within the financial marketplace circulate. Of course, to start with, you have the savers or the so-called investors. They invest their money by exchanging their cash for financial instruments to the financial institutions. So, after which, the financial marketplace where financial institutions operate obtains, of course, your financing. And after obtaining the financing from the savers, then the financial institutions will lend those money to the borrowers for interest. And then later on, if such loan comes due, the borrower will now repay the financial markets or the financial institutions. In the financial markets, we have different financial institutions that act as intermediaries. So there are commercial banks, finance companies, insurance companies, investment banks, and investment companies. For securities markets, we have the debt markets and stock markets. So intermediaries. Financial intermediaries or financial institutions like commercial banks, finance companies, insurance companies, investment banks, and investment companies are called financial intermediaries, as they help bring together those who have money or the savers and those who need money or the borrowers. Now, your financial institutions are like intermediaries or bridges that link together or that brings together the savers and the borrowers. Money market versus capital market. A money market are markets for short-term debt instruments with maturities of 1 year or less, such as treasury bills. Of course, your treasury bills is issued by the government, and commercial paper. So basically, when you talk of money market, it is where short-term loans and investments are found. Okay? So these are, or if you need money in a short term, or you need money and you want to pay such money for less than 1 year, then you go to the money market. So they issue commercial papers, or if the government needs funding for a short term period, then the government may issue short term treasury bills and other forms of cash equivalents that, or the maturity of which is less than 1 year. Now, capital market are markets for long-term debt and equity instruments such as common stock, preferred stock, corporate bond, and US or Philippine Treasury bond. So, if you need capital and such capital is repaid, or the realization of which, or the payment of which extends to more than 1 year, then you go to capital market. Commercial banks, everyone's financial marketplace. So what is a commercial bank? Commercial banks collects the savings of individuals as well as businesses and then lend those pooled savings to other individuals and businesses. They earn money by charging a rate of interest to borrowers that exceeds the rate they pay to savers. So it must be that if you are a commercial bank, the interest to your loans to your borrowers is more than the interest you pay to your savers in order for you to earn profit for that interest. So in the United States, there are the four largest commercial banks is the JP Morgan Chase and Company, Bank of America Corporation, Wells Fargo Bank, and Citigroup Incorporated. While in the Philippines, we have several large commercial banks here, such as BDO, Metro Bank, Philippine National Bank, and etc. We also have non-bank financial intermediaries. So these include financial services corporations such as GE Capital Division, insurance companies such as Prudential, investment banks such as Goldman Sachs, investment companies including mutual funds, hedge funds, and private equity firms. Now, there are other financial intermediaries which may not be considered as bank. So they are considered non-bank financial intermediaries so long as both the savers and the borrowers meet together, then such an intermediary is considered to be a financial intermediary, although it may not be considered as bank because there are qualifications and regulations for a financial intermediaries or financial institution to be considered as bank. However, if those financial intermediaries are not commercial banks, although they are considered to be a rendezvous of borrowers and savers, they will be considered as non-bank financial intermediaries. Financial services corporations. Financial services corporations are in the lending or financing business, but they are not commercial banks. So we have corporations, though not considered to be commercial banks, but they provide financial services. For example, GE Capital, it provides commercial loans, financing programs, commercial insurance equipment leasing, and other services in over 35 countries. Now, in the Philippines, particularly in our region, we have the, of course, very common LYR, Lending Company. So, LYR, Lending Company, provide loans to borrowers and also financing programs. For, let's say, if someone wants to buy a house, then he could apply for a financing program to LYR company or LYR lending corporation. Although LYR is not a commercial bank, is not a bank per se, but it is still considered a financial service corporation. Insurance companies sell insurance to individuals and businesses to protect their investments. So, insurance companies is not new to us because we hear a lot of these, like someone would approach us if we want to insure something. Okay? So, they collect premium and hold the premium in reserves until there is an insured loss and then pay out claims to the holders of the insurance contracts. The reserves are deployed in various types of investments, including loans to individuals and businesses. So, the source of capital or investments by insurance companies are from individuals who want to insure something. Say, for example, someone would like to insure his life, or someone would like to insure his business, or his building or his equipment. Then he would go to insurance companies, and of course, he has to pay premium, and that premium paid by an individual who wants to be insured will be used by these insurance companies to invest. Okay? So, those insurance companies will invest the premium and would have and will earn potential income as well from those investments, from the premium. And the premium as well as the income earned from the investment of such premium will be used as payment if someone is qualified to be paid with such premium. Investment banks are specialized financial intermediaries that help companies and governments. So if when you say investment banks, it is where companies and governments raise money and that provide advisory services to client firms when they enter into major transactions such as buying or merging with other firms. So for example, if you're a company, you want to invest a large amount into a particular corporation, or you want to buy a particular corporation, then you have to go to investment banks because they will provide you with advice, or they will assist you, or they will be the one to find for potential firms that may be acquired. And if government also needs additional financing, then the government may approach or may enter into a contract or agreement with investment banks. Investment companies, mutual funds, are professionally managed according to a stated investment objective. Through mutual funds, individuals can invest in virtually all of the securities offered in the financial market. So, mutual fund investment companies basically pulls different types of investment from different issuing corporations or companies. So, if you're an investor and you want to invest into virtually all the securities offered in the financial market, for example, you want to invest in the stocks of, again, if you're an investor and you want to invest in the stocks of different companies in the financial market, or you want to invest in or to buy debt securities or equity securities, then mutual fund companies is your place. Individuals can invest in mutual funds by buying shares in the mutual funds at the net asset value. Mutual funds can either be load or no load funds. Load refers to sales commission. So if mutual funds are in a load funds or on a load basis, the mutual fund company will just earn commission on the sale of a particular security. For example, if BDO wants to sell securities, then or through a mutual fund, then a mutual fund where BDO asks to sell his security will just earn a sales commission. But if it is on a no load funds, BDO are assured of a particular amount. Whatever, if ever the mutual fund company will sell the securities of BDO at above or below the assured price, then the mutual fund will handle or will absorb the risk. Investment companies, exchange traded funds or ETFs. An exchange traded fund is similar to a mutual fund except that the ownership shares in the ETF can be bought and sold on the stock exchange through the day. So most ETFs track an index such as S&P 500. So basically, class, S&P 500 are the top, or that this is the top 500 companies on a particular securities market. Mutual funds and ETFs provide a cost-effective way to diversify, which reduces risk, a great benefit for the small investor. Remember that when you diversify, say you are when you say diversification or when you diversify, it means that you invest into more types of securities for different types of companies, in which way you reduces the risk of not having a return of your investment. So again, diversification is a strategy if you want to reduce risk associated with your investment. Investment companies, hedge funds. So hedge funds are similar to mutual funds but are less regulated, take more risk, and are generally open only to high net worth investors. Management fees are higher for hedge funds. They typically run at about 2% of the assets and include an incentive fee, typically 20% of profits, based on the fund's overall performance. So a hedge funds, basically a hedging companies. So a hedge fund, it is where, or it is just like a mutual fund. So a hedge fund, for example, I have a 20,000 US dollar in my bank account, or in, let's say, in my pocket, and I want to exchange my 20,000 dollar into Philippine peso. So in order to lessen the risk that the exchange rate may be lower or higher, then I will go to hedge funds companies because they will assure me of the exchange rate in a particular day. For example, if I go to a hedge fund to exchange my 20,000 US dollars, then they will give me a particular amount. Say, the exchange rate for $20,000 will be 51 pesos on a particular day. So, even if the exchange rate on that, or the actual exchange rate on that particular day, is less than or more than 51 pesos, then I am assured that the exchange rate at that particular day will always be or will remain to 51 pesos. So I am reducing the risk that maybe on that particular day, if I did not went into, or I did not enter into a contract to a hedge fund companies, maybe the actual rate or the actual exchange rate could be less than 51. So it is a loss. But if the actual exchange rate is more than 51, say 52, then it could be a gain. But what if at that particular day that you are actually exchanging my 20,000 US dollars, the exchange rate is 50 pesos. So it is a loss on my part. Okay, so that is what hedge funds companies do. They provide you with a fixed amount of or a fixed rate of a particular commodity at a particular date. So you will reduce or the risk will be lessened. Investment companies, private equity firms. So private equity firms is a financial intermediary that invests in equities that are not traded on the public capital markets. Two types of private equity firms dominate this group, the venture capital and the leveraged buyout or LBO. So basically, investment companies or private equity firms, it is a financial intermediary if an investor and the borrower meets where the borrower or the of course the say corporation who wants to raise capital, the stocks of which corporation is not traded in the public capital markets. Private equity firms, venture capital firms. Venture capital firms raise money from investors, wealthy people, and other financial institutions, which they then use to provide the initial financing for private startup companies. For example, initial financing of Google was provided by a venture capital firm called Kleiner Perkins Cofield and Byers or KPCB. So if you want to build or to start a business and you do not have enough financing, then you can borrow money from a venture. Because if you want to build or establish or start a company that is considered to be a venture, okay, so if you lack financing or you need financing, then you go to venture capital firms to start up your company or your business. Leveraged buyout firms acquire established firms that typically have not been performing well with the objective of making them profitable again and then selling them. An LBO typically uses debt to fund the purchase of a firm. So basically what LBO firms do is they enter into agreement or a contract to buy a particular firm that is not performing well and then provides such firm or not well performing firm with a leverage that such firm will be or will become profitable again and then selling them. Now, the financial marketplace or securities markets. A security is a negotiable instrument that represents a financial claim. It can take the form of ownership stock or a debt agreement bond. The public securities markets allow businesses and individual investors to trade the securities issued by public corporations. So basically, a security, it represents a claim or a financial claim. And if it is a claim, it could be what? It could be a stock or ownership. If it is ownership, then it is in the form of stock. And if it's not ownership, but it is debt agreement, then it is in the form of bond. Primary market. A market in which securities are bought and sold for the first time. So the firm selling securities receives the money raised that they can then use to finance their businesses. So primary market, this is where startup businesses or startup corporations sell their securities. So if you are just a newly established corporation, then your shares or your authorized share capital may be issued in the primary market. So your authorized share capital are those capital that are not yet subscribed or that are not yet sold to investors. Then you can go to financial market to issue them. In a secondary market, it is a market for subsequent trading of previously issued securities. So the issuing firm does not receive any new money as the securities are simply being transferred from one investor to another. So now, as what we have talked earlier, in a primary market, it is where you first issue your, let's say, shares of stock, or let's say common stock. So if you are a new firm, you have this what we call authorized share capital. So an authorized share capital uh, may not be issued yet for the first time. So if it is already issued for the first time through a primary market, then of course you have now the stockholders. The stockholders are those who buy the shares in the primary market. Now, stockholders may trade, as stockholders, your stockholders or your shareholders may trade these shares of stock in the secondary market. So you no longer receive cash. Okay, as a company, you no longer receive cash because it is already the shareholders or the stockholders holding such shares or stock, selling or trading such shares or stocks in the secondary market. Here we have figure 2.2, or securities market provide a link between the corporation and investors. So step 1, here is the primary market where securities are sold for cash by the corporation to the investor. So upon receiving by the corporation of such cash, then the corporation will what? Will invests in returning or in return generating assets. So if the corporation receives cash, the corporation will now use such cash to whatever may be necessary for the use of such cash, and in return generating another sets of assets. And then those cash flow from operation will be what? Will be distributed first to the government for the taxes, and then the remainder will be distributed back to the investors. And step 4, securities are traded among investors in the secondary market. So those securities bought by the investors will be traded in the secondary market. So for example, an investor or the stockholder sells the stocks or shares to another investor. Okay, so it happens in the secondary market. Types of securities. You have first the debt securities. Okay, a debt security, firms borrow money by selling debt securities in the debt market. So if you are a creditor, okay, so you may go to a debt market if you want to lend money but you don't want to be an investor. So debt is classified based on maturity period. If the debt is less than 1 year, issued in money market. Okay, so again, if the debt you want to, or if you want to lend money in less than 1 year, then it is issued in money market. Short-term money, short-term debts. Okay, it is found in money market. 1 to 10 years, that's called note or bonds issued in the capital market, because in the capital market, this is where financing of a long term is found or happens. More than 10 years is called bonds. Bonds issued in capital market, because bond is a long-term debt. Again, if you issue debt securities in a debt market, then you as the issuer, you as the lender does not become the owner, but a creditor, a mere creditor of the issuer of the debt securities. Now, the issuer, siya yung nag-i-issue ng debt securities for money to the creditors. So basically, yung issuer is the borrower. And then yung issuee or the lender, siya yung creditor. Siya yung nagpa-utang sa issuer ng debt securities. So again, it could be short term. If it is short term, then it is in the money market. But if it is long term, it is in the capital market in the form of note or bond. Now, if it is an equity securities, it represents ownership of the corporation. Again, if it is equity securities that is issued, then ownership happens or transpire. There are two major types of equity securities. You have the common stock and preferred stock. When you buy equity securities, you are making an investment that you expect will generate a return. Again, the difference is that if you are issuing or if you are a debtor or if you're a creditor in the market, then you are no longer expecting because interest is imminent into the money you lend to the borrower. But if you are an investor in equity securities, then you become the owner. You become a part owner of that corporation. Okay, you are an investor and you expect a return on investment. So, common types of securities, you have common stocks. Okay, it is a security that represents equity ownership in a corporation. So again, a common stock, it represents ownership. It represents ownership in a corporation. Provides voting rights. Again, a common stock provides voting rights. So when you say voting rights, it means you can vote whenever there is an election for board of directors and any other activities necessitating the vote of common stockholders and entitles the holder to a share of the company's success in the form of dividends and any capital appreciation in the value of the security. So investors who purchase common stock are the residual owners of the firm. When you say residual owners, you are the owners or you receive claim of ownership of the firm after paying the creditors and the preferred stockholders. Now, preferred stock is an equity security. It gives preference relative to common stockholders with regard to dividends and claim on assets. So, if you're a preferred stockholder, then there is a preference. You are preferred over common stockholders with regard to dividends. Thus, preferred shareholders receive their dividends before any dividends are distributed to the common stockholders. So basically, a preferred dividend or a preferred shareholder receive first dividends before the common stockholders. Stock markets. A stock market is a public market in which the stock of companies is traded. Stock markets are classified as either organized security exchange or the over-the-counter market. An organized security exchange occupies physical space and financial instruments are traded on their premises. So basically, there is an establishment where instruments are traded. For example, the NYSE located in New York. You have the Philippine Stock Exchange located in the Philippines. So the common stocks of nearly 3,000 listed companies is traded on this exchange in NYSE or the New York Stock Exchange. Now the NASDAQ or the National Association of Securities Dealers automated quotation is an over-the-counter market and describes itself as a screen-based floorless market. In 2013, nearly 3,100 companies were listed in NASDAQ exchange including Starbucks, Alphabet, Intel, and Whole Foods. So basically, an over-the-counter market does not have premises like organized security exchanges because from the term itself, NASDAQ, it is automated. Okay, automated and it is based on screen or screen-based. Just like your cryptocurrency where you do not really actually hold an actual money but a crypto or an e-money. Other financial instruments provides Table 2.2 provides a list of different financial instruments used by firms to raise money. Beginning with the shortest maturity instruments, the US Treasury bills or the Philippine Treasury bills, they're traded in the money market, and moving through to the longest maturity instruments, which is the common stock, because a common stock matures matures at the end of the life of a corporation that are traded in the capital market. So money market debt for the borrower, good way of inexpensively raising money for short periods of time. Rates tend to be lower than long-term rates because money market where short-term debts are found, of course, if it is a short-term debt, it gives short or it requires short or lower rates. Can borrow money to match short-term needs, and if interest rate rise or rates rise, the cost of borrowing will immediately rise accordingly. Now, for the investor, very liquid investors have access to their money when they need it because it falls due on a short period for less than 1 year. So, pag kailangan mo na agad, you no longer have to wait for years to um, collect your credit. Okay, because in a money market, again, it is where short-term debts are found. Okay, it is safe, generally invested in high quantity or quality investments for brief periods, less than 1 year. Low returns, rates tend to be close to the rate of inflation. So again, if you want to lend money, the interest rate that you should require to lend money should be higher than the inflation rate. Long-term debt and fixed income securities for the borrowers. Interest rates are locked in over the entire life of the debt. It has a tax advantage over common stock in that interest payments are tax deductible whereas dividend payments are not. Okay, so this is an advantage on a debt type of investment because the interest, okay, for example, you borrow money, okay, if you borrow money, then the interest expense is deductible from computing your tax due. But a dividend, if you issue equity securities, of course that is shares of stock, common stock or preferred stock, the interest is apparently the dividend that you pay. And again, if you pay dividend, it's like again an expense, but because it is a dividend or the return on investment to the investors, then it is not a deductible, or it cannot be deducted in computing your income tax. For the investor, it can be used to generate dependable current income. Some bonds produce tax-free income. Long-term debt tends to produce higher return than short-term debt. Of course, the longer the debt, it gives you more interest, less risky than common stock. Because whenever a corporation borrows from a creditor, okay, or whenever a corporation have credit and that corporation gets bankrupt, the assets of the corporation will be first applied to the debt of the creditor before paying the claims of the common stockholders. Investors can lock in an interest rate and know the future returns, assuming the issuer does not default on its payment. So again, if you're an investor or the creditor, you can lock in your interest. Okay? And if you lock in your interest, you carry the risk that the interest may rise or may fall. Preferred stock for the issuer. Dividends can be omitted without the risk of bankruptcy because the corporation or before the corporation issues dividends, okay, it must be or it is the board of directors that will decide if they issue dividends. So the board of directors may decide to delay issuing dividends. It has the disadvantage that dividends are not tax deductible for the issuer, whereas interest payments from debt are again tax deductible. For the investor, for corporate investor or investors, it has a tax advantage because at a minimum 70% of dividend received are tax free. So, characteristics of different financial instruments. You have instrument, again, preferred stock, market, again, capital, capital market because it is an equity, long-term, major participants issued by corporations to individuals, other corporations, and institutional investors. Riskiness, riskier than corporate bonds, but less risky than common stock. So why is it riskier than um, corporate bonds? Because again, bonds are debt securities. Whenever a corporation gets bankrupt, the assets of the corporation are first paid or applied or used to pay those uh, bondholders or the creditors holding bonds. Okay? Whenever there is a residual income or a residual asset, after paying the bondholders, then you'll now have to pay the preferred stockholders. After preferred stockholders are the common stockholders. So again, it is riskier than corporate bonds but less risky than common stock. Again, it has no original maturity. It has no maturity date. Your preferred stock. Interest rate dependent on risk, generally ranging from 4% to 8.6%. So this is basically the economic statistics of the riskiness or the interest rates of preferred stocks. Common stocks for the issuer. The issuing firm is not legally obligated to, again, to make payments. It does not have a maturity date just like your preferred stock. Issuance of common stock increases credit worthiness because the firm has more investor money to caution the firm in the case of a loss. It has a tax disadvantage relative to debt. Again, because the dividend paid by the corporation to common stockholders is not a tax deductible expense, whereas debt interest payments are deductible for tax purposes. Common stock dividends are not, again. For the investor, over the long run, common stock has outperformed debt-based financial assets. Along with the increased expected return comes increased risk. So, the higher the risk, again, the higher the return, or the higher the return, the higher the risk. Okay, common stocks. Again, the market is capital, or because it is an equity, major participants issued by corporations to individuals, other corporations, and institutional investors. Riskiness, risky, with dividends paid only when they are declared. No maturity date. Again, the dividends of a common stockholders are just paid whenever declared by the board of directors. Again, no maturity date, just like preferred shares, and it do not pay interest. So again, unlike preferred stockholders, the dividend paid to preferred stockholders is considered to be interest, while the dividend paid to common stockholders is not considered as interest. Financial markets and the financial crisis. So beginning in 2007, US experienced its most severe financial crisis. So this is actually the 2008 global financial crisis. Although many factors contributed to the financial crisis, the most immediate cause has been found to be the collapse of the real estate market. So it is where the real estate properties such as land and building are being sold in this real property market, and the resulting real estate loan or the mortgage defaults. Because if you want to if you want to have a loan, okay, your real estate will be considered, or if you own a real estate and you have a loan, then your real estate will be your mortgage. And because of the 2007-2008 global financial crisis, those mortgage comes into defaults. So, payments are defaulted. Securitization process. So, home buyers borrow money by taking out a mortgage loan. So, they borrow money. They borrow money by taking out a mortgage loan for their homes. Lender sells the mortgage to another firm or financial institution. That financial institution pulls together the sold mortgage by the lenders and creates a portfolio of mortgages or portfolio. It is where different types or different mortgages are being found, and the purchase of that portfolio is financed through sales of MBS. These MBS are sold to investors who can hold them, so the portfolio, as investments or resell them to other investors. So since the original lender gets the money back quickly and does not have to worry about repayment, it may not adequately screen the loan applicants. So financial crisis began with poor screening and spread worldwide. So the one of the reasons or one of the causes of the 2007-2008 global financial crisis is due to poor screening of such sold portfolio and spread worldwide. So that Dodd-Frank Wall Street Reform and Consumer Act. So in the wake of the 2008 financial crisis, the financial industry was again transformed. The major standalone investment banks failed or were converted to commercial banks. So there are no longer investment banks where big companies and governments meet, okay, or go if they want to raise and do substantial business transactions. In 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed, which subjects banks and non-bank financial institutions to more oversight. There is now more oversight and greater transparency, just like the Sarbanes-Oxley Act. One of the values, the Volcker Rule, prohibits banks from proprietary trading. Now, I have here a research activity. This will be sent and submitted to your Microsoft Teams. Okay. Number one, you research about what happened to the Philippine financial market during the 2008 global financial crisis and what strategies and policies the Philippine government made to combat and mitigate the effects of the 2008 global financial crisis. So, and here are the key terms of what we have just discussed. Okay, and that ends the topic. Peace.